Service businesses operate on a straightforward accounting model. When a company sells consulting, legal advice, or technical expertise, it trades intangible time for cash. This diagram outlines the standard formula for a service firm. Total revenue minus the operating expenses equals net income. But when a business shifts from selling time to buying and reselling physical products, that simple equation fails to capture the full picture. Tracking physical merchandise requires a specific accounting framework. Notice how inventory changes the formula. The calculation splits into a layered hierarchy. Sales revenue minus the specific cost of goods sold equals gross profit, before factoring in operating expenses to arrive at net income. To see how goods generate this layered profit, we have to construct the perpetual inventory framework from the ground up. Analyzing a merchandising firm means leaving single-step accounting behind. We have to map a system that tracks a physical asset continuously, from acquisition to the final sale. Under a perpetual inventory system, the accounting records mirror the physical reality of the warehouse. The inventory ledger is updated in real time every time an item moves. Consider a standard retail transaction where a customer purchases a product on credit. This split screen illustrates how one economic event requires two simultaneous accounting entries. On the left, we track the selling price. On the right, we track the product's actual cost. First, we record the value charged to the customer. We debit accounts receivable to show the money owed, and credit sales revenue to recognize the income earned from the sale. Simultaneously, we recognize the removal of the physical asset. We debit cost of goods sold and credit merchandise inventory to remove the item from the ledger. The distinction between these tracks is the valuation. The revenue entry uses the retail price, while the inventory entry uses the historical acquisition cost of those specific goods. Cost of goods sold is treated separately from standard operating expenses like rent or payroll. It represents the direct value of the specific inventory that just left the building. Without this dual-track entry, management would see the revenue they generated, but would not see the specific assets consumed to earn it. To understand how that product cost is calculated, we have to examine the beginning of the operating cycle, acquiring the goods. The merchandise inventory account functions as a cost pool. When we buy goods, the base purchase price, say $8,000, enters the debit side of this container. The rule of inventory capitalization dictates that any necessary cost incurred to acquire a product and prepare it for sale is added to the inventory asset. Suppose the buyer pays a $400 freight charge under FOB shipping point terms, meaning they assume ownership the moment the goods leave the supplier. Because the buyer owns the goods in transit, they do not record this transit fee as a separate expense. Instead, the $400 freight-in charge is added to the base price, increasing the total value of the inventory asset. This principle also works when a buyer receives a price reduction, such as a purchase discount. Suppliers frequently offer terms like 210 net 30, meaning the buyer receives a 2% discount if they pay the invoice within 10 days. By taking that early payment discount, the buyer lowers the final amount paid for the goods. We credit the merchandise inventory account, reducing the recorded cost of the acquired asset. The buyer's inventory account is updated continuously to reflect these changes, setting the exact figure that will eventually become the cost of goods sold. Let's shift back to the seller's perspective. We examine how a business handles transactions when a customer alters terms after the initial sale. A customer might return a defective item for a refund, or they might pay their invoice early to claim a sales discount. When these changes occur, the seller does not directly reduce the primary sales revenue account to reflect a lost income. Instead of altering the main revenue block, the seller uses contra-revenue accounts, sales returns and allowances, and sales discounts. These are negative value accounts that reduce gross sales to show the effective revenue. Management uses these contra accounts to analyze gross sales performance, separate from the actual dollar amount lost to returns or customer discounts. A customer return also requires a reversal of the dual-track system. If the returned item is in sellable condition, the seller restores the asset to the books. We debit merchandise inventory to put the product back, and credit cost of goods sold to reverse the original expense. Utilizing COGS or revenues allows the seller to track their total market demand while accurately calculating the final, fully realized economic benefit. The daily journal entries, the cost pools, the dual-track sales, and the contra-revenue accounts all feed one specific analytical document. The multiple-step income statement isolates profitability into distinct layers. First, subtracting contra-revenues from gross sales establishes net sales. Next, subtracting cost of goods sold yields the gross profit. Gross profit shows whether the retail markup covers the product's historical cost. By dividing gross profit by net sales, analysts determine the gross profit rate, a percentage used to evaluate pricing and purchasing margins. In the final layer, we subtract operating expenses from the gross profit. This isolates income from operations, eventually leading to the final net income. Unlike a single-step equation that combines all costs, this layered structure shows exactly how the product markup contributes to final profit. Merchandising accounting relies on separating the cost of acquiring physical assets from the revenue generated by their sale.